Okay, we can start. I'm very sorry for the delay. It was a mess to upload the paper and to have the microphone opened. So uh, we did not finish the second chapter. We are still in the second chapter devoted to CSR and socially responsible investing. So I will skip what we have already done. And I want to focus now on two specific aspects. Okay, as I said, I want to focus on two specific aspects. First, green bonds and impact bonds. Oh, what happened? Okay, so green bonds and impact investing. Remember, when you buy a socially responsible fund, when you buy such a fund, usually you will have to screen some stocks. So you can exclude thin stocks, you can exclude firm which produce negative externalities. So we call them thin stocks. For instance, tobacco, alcohol, fossil fuel, and so on. The list of thin stocks can be very large. You can just avoid those firms. You can also include firms with good positive externalities. For instance, about photovoltaic or waste management. So you will add those firms in your portfolio. So you can do screening. You can use a best-in-class approach. With a best-in-class approach, which is very popular today, with a best-in-class approach, you do not exclude any firm, any sectors, but you pick the best firm in each sector. So you, in that case, in your portfolio, you will have some oils firm, but the best firm among the firms in the oil industry. Improve the process toward, for instance, climate change. So you can do screening, positive screening, negative screening. You can do also best in class, but in all those cases, you are never sure to have an impact. It is good to do screening or to use a best in class approach, but you do not have a significant, genuine impact on sustainability. Okay. So now we have a new generation of sustainable investment. The new generation of sustainable investment is about impact investing. When you invest in an impact bond, or we can say an impact portfolio, you seek to have a strong impact. You just not exclude some firm, you want to have an impact. So we have today a popular network, the Global Impact Investing Network, or GIN, Global Impact Investing Network. And they provide some guidelines in order to foster the development of impact investment. So what is the definition of impact investment? Impact investments are investments made with the intention to generate positive, first criteria, positive impact, a measurable impact. This is very important to be able to measure your impact. And this impact is about, of course, social issues or environmental issues. And you have to measure the impact. For instance, if you want to invest in an impact bond or an impact portfolio, you will have to precise the amount of reduction in carbon emission. If I invest in such portfolio, can I reduce my ecological footprint by 10%, 50%? Okay. You have to measure clearly your impact. The most important issues for impact investing are climate change, of course, it is not a surprise, but it is also about gender diversity. We call that gender lens investment. It is a subsection of impact investing, and they attempt to have an impact into companies, organizations, to create a more gender-friendly environment. The most important topic about impact investing is global warming and gender diversity. You can find a lot of documents about impact investment in the GIN website. I will just give you some comments. Usually in the guidelines about impact investment, three criteria are important in terms of intentionality, measurement, I have discussed about measurement, and additionality. You should have an additional impact. I will define these three concepts which are important in this discussion. So what is intentionality? Intentionality is defined by the GIN as the investor's intention to contribute to the generation of a measurable social or environmental benefit. You should explicitly describe what do you want. Your goal should be very explicit. It is too easy to say, I want to improve the environment. I want to fight climate change. It is very easy to say. It is not so easy to do. So you have to be very explicit. Or do you think you will have an impact? You have to be very clear about your goals. This is the intentionality. Okay? Just not to say, I'm a good guy. It's not enough. I'm a good investor. I'm a responsible investor. It is not enough. You have to show your goal. You have to explicit your goals. For instance, I want to reduce carbon footprint by 5%. I want gender diversity, for instance. Half of the executive member should be women, for instance, with a clear goal, not something generic, which is not very interesting. Okay, so the intentionality is an important feature, and it has to be very clear. Additionality. Yes, the question of additionality, it's quite important also. Because of your action, you should have an additional impact. The question you have to ask is, what difference would it have made if the asset had not been financed by this specific investor? I will just consider an example. For instance, you buy a bond issued by a firm to finance green transportation, a subway, for instance. There is a subway, I don't know where, in a city, in an emerging country, and to finance this new subway, the firm issue bonds. You can buy such bond, but it is not impact investing. Even if this investment is towards sustainability, because there is no additionality in your action. You buy a fund which bonds which already finance something, some project which are sustainable. So you need a concrete manifestation of intentionality and additionality. And I have discussed about that. The third important feature is to be able to measure your impact. How to measure your impact. It is not easy, and we will consider this problem in the fourth chapter. Later, we will discuss how to measure environmental impact, social impact. It is not easy. Not easy at all, because environmental impact, social impact are very often qualitative. It is always difficult to measure qualitative aspect. Carbon footprint, the amount of carbon emission, it is easy to measure, of course, but diversity, not so easy to measure. Okay, so you have to find solution for qualitative and quantitative measurement. Okay, intentionality, additionality, and measurement are the three pillars of impact investing. There is not a lot of academic paper about impact investing, but there is one by Barber, Morse, and Yasuda, who are researchers at the University of Berkeley in California. So it is, of course, a very well-known university, and Barber is a very well-known researcher, and he has published a paper about impact investing. So they examine a lot of funds, more than 4,000 funds, and among them we have 159 impact funds. So a small portion of impact fund, but as I said, it is a new phenomenon, so it is not a surprise. We have a small number of impact funds, but we can test whether those impact funds provide lower returns. It's important because they try to have an economic and a social impact, but the consequence of that is that the return is a little bit lower. And you can find some investors who agree to have a lower return, but in exchange to have an ecological or social impact. So they consider this database and they show empirically that the internal rate of return, about the internal rate of return, IRR. This return for impact fund is a little bit lower than return for traditional fund. Actually, impact funds are usually venture capital funds. It is not funds composed with listed company, but with private company. Okay, just a parenthesis. But what is important to remember is that investors accept lower expected financial return. They accept that in exchange for non-pecuniary benefits. So there is a market for that. And the willingness to pay for impact is measured by this author between 2.5% and 3.7%. So it is a small amount, but it is good to see that some investor can accept lower financial returns. Okay. As I said, there is not a lot of paper about impact investing, but more and more paper. I give you the reference of this paper if you want to have more detail about the methodology in this paper. Okay, if you look at impact bonds or impact investments in Asia, as I said, it is a new phenomenon, impact bond. It is the new generation of sustainable investment. And in the US, we have seen it in the previous slide, only 159 bonds in the US, which is, of course, the largest market for impact investment. In Asia, it is much less known for the moment. And in particular in Vietnam, I didn't find any impact investment fund. So I have find a paper by the GEAN, the network I have spoken about impact investment in Asia. As you can see, and you know about that, Vietnam is a small market even in Asia. It is not about impact fund. It's about traditional investment here, the number of deals and the capital deployed in general for different countries. So a high number of deals in Vietnam, but low amount for the moment, of course. It grows. It is growing. So you can see this report. And you can have, of course, again, I give you the reference if you want to need some details. Okay. We have also some social impact bonds. So it is related to impact investment, but somewhat different. So social impact bond do not. There is a confusion, but you have to be very clear. Impact investment and social impact bonds are related, but it is not exactly the same. So I will discuss about social impact bond or SIB. It would be better to say SIB. Okay. SIB is a very innovative financing mechanism. It's very innovative. In this case, a government enter into an agreement with a social service provider. So a social service provider, usually it is an association, a non-profit organization. So we have the government, a non-profit organization, and investors. Okay. And it is a contract between these three actors. And the agreement is to pay investors only for the delivery of a predefined social outcomes. So it is very innovative, and to understand, I will give you an example. Actually, we call that social impact bond or SIB, but it is not a bond. It is not really a bond. It is more than a future contract. Maybe you know about derivatives. I hope you have some class about derivatives, about futures. Okay. It is more like a futures than a bond. And instead of social impact bond, sometimes we call it payment for success bond or pay for benefits bonds. And this denomination are clear. Payment for success bond. In a traditional bond, you pay each year a fixed amount most of the time. So it is very simple for traditional bond. In a SIB, you pay only if the project is a success, and it is a social project, not a financial project. It is a social project. And if you have a social impact, you will pay. If you do not have a social impact, you do not pay. So the investor takes more risk, and it takes risk about social issues. So the first one, I said that I can give you an example. I will show this graph later, but I will give you first an example. The example of the first social impact bond. It was about 10 years ago, in 2010, in the UK. It's a very innovative example, a very innovative approach. Social Finance, which is a non-profit organization, raised 5 million of GDP from trust and foundation to reduce reoffending among short sentence offenders. Okay. So the social impact is very important, is to reduce reoffending. And the idea is that an association, which is called One Service was offered support for the prisoners. Okay. You know that after going in jail, some prisoners are tempted to reoffend. So this is, of course, a very strong concern for the society to avoid reoffending among prisoners. And it was about male prisoners, because male prisoners are the percentage of prisoner. The percentage of male prisoner is very high, of course, compared to female. Okay. So the Ministry of Justice in 2017 has announced that this project, the Peterborough Social Impact Bond, had reduced reoffending by 9% because of this support which has been financed. They support previous prisoner, the percentage of reoffending decreased by 9%. And in the contract, the goal was to reduce by at least 7.5%. So the target has been achieved, is a very good result, and because of that, the investor was paid. Okay. This is a very good example of SIB, the first one actually. So I hope it was clear for you. I can just here present this graph. This graph is from a paper by OECD. It was about SIB. And so, as you can see, it is, as I said, an agreement between investors, social service providers, a population in need. It was incarcerated prisoner in the previous example, but it can be homeless, it can be aging seniors, and the key in this agreement is this concept of payment for success. You pay only if there is a success. So it is like a contingent bond. There is a criteria, and you have to achieve a target, and it is a social or an environmental target. Usually it is a social target for the moment, but we can imagine an environmental target. And if you achieve the target, you pay the investor, otherwise you don't pay. And we have several initiatives, and sometimes it happens that the target is not achieved. Okay, so there is a risk for investors. Okay. Okay. I have finished about impact investment and social impact bonds. I have finished about that. Do you have any question? Okay. So another interesting aspect in sustainable investment is shareholder activism. So it is also a way to achieve sustainability, but you will see it is very different compared to what we have seen already. So what is shareholder activism or shareholder engagement? It is mostly an Anglo-Saxon tradition. And the idea is not to exclude or to favor a firm because we dislike or because we like it. No, the idea is to buy some share, and when you buy a share, you are a shareholder, so you are the owner of the firm, so you can change the strategy of the firm. And because you can change the strategy of the firm, you can help companies to be more environmentally friendly or socially friendly. The idea is not to exclude or include, but to be an owner and a responsible owner, not just a responsible buyer, but also a responsible owner, and to be active and to be very and to be included in the dialogue with the management. Okay, to be very active in the exercise of voting right. It is shareholder activism, and to understand this concept, I mention here a very well-known book by Alfred Hirschman, which has been published 50 years ago, but still an important book. The title of the book is Exit, Voice, and Loyalty. Exit, Voice, and Loyalty. It is a very impactful book. And Alfred Hirschman describes how you can react when you are involved in an organization. You can react in 3 different ways. You can be loyal. If an organization, most of the time a firm, if an organization take a decision, you can agree or disagree, but you still be loyal to the firm. It is the first reaction. If you agree, there is no problem, but if you disagree, still you stay loyal. First kind of reaction. A second kind of reaction is to say, I disagree, so I leave. This is the exit strategy. I disagree, so I leave. Very clear, very simple. But there is also a third strategy. The third strategy is to say, I disagree, but I will explain why I disagree. And I want you to discuss with me. I want you to consider my voice. Okay. I want a discussion, and maybe after this discussion, you can change your mind. So I will not exist. I will try to change your decision. 3 different kind of reaction when you disagree in an organization. Exit, voice, loyalty. You have to choose. So this is a very general approach, which has been described by Alfred Hirschman. But now you can apply this approach to sustainable investment. Okay. We will try together to apply the Hirschman approach to sustainable investment. So you are an investor. You can be loyal. So you can actually, you have to be very conservative in this case. You can be loyal. You have share of a company. The company takes decision, and you can be confident in this decision, and you stay loyal to the CEO of the company. Even if you disagree, you consider that the CEO has surely some good intention. So you stay loyal. First reaction. The second reaction is to say, okay, I do not agree with the decision of the CEO. I do not agree with that, so I will sell my shares. And if you are allowed to do like that, of course, you know about that. The price of the share will go down. Okay. So if a lot of shareholders disagree, it is not a good news for the CEO because the stock price will decrease. It is an exit strategy, and it is the case when you do exclusion. We have discussed about screening in investment. If you apply a screening approach, it is an exit strategy. And the third strategy is about voice. You are a shareholder, so the CEO is your employee. Because you are a shareholder, the CEO is your employee. So you can propose some social or environmental resolution during general meetings of shareholders, and there will be a vote, and if the vote receives the majority, the CEO has to execute your resolution. So you can change the corporate policy because, again, you are the owner of the company. And it was the definition of shareholder engagement or shareholder activism. You can use the both words. Okay, I will give you an example of shareholder activism, a real example of shareholder activism. It was done by a very well-known NGO, Amnesty International. I'm not sure you know, but it is a very famous international NGO, so Amnesty International. And Amnesty International has a business and human rights program. And in 2006, they launched this program with a budget of $15,000. And try to guess, what was this budget used for? Try to guess. I give you two solutions. One solution is real and one is not. So this $15,000 has been used to pay an advertising company to denounce the action of Dow Chemical, ExxonMobil, and Yahoo, or to buy shares of Dow Chemical, ExxonMobil, and Yahoo. It is an NGO, not an investor. Sorry. We consider an NGO, not an investor. They pay for an advertising campaign, or they buy shares of polluting firms. The right answer is the second one. They both shares of polluting company. It is quite innovative, quite surprising. And why they buy shares? They buy shares because they want to be part of the general meeting. They want to discuss with the CEO about the strategy of the firm. So they buy shares. So because they buy shares, they are shareholders, they are owners, and they can propose some resolution. It is a very innovative approach to propose some resolution, and the resolution was related to environmental issues, of course. This is more and more frequent in the US, in Europe and Asia also, but mainly in the US. In the US, the regulation is very clear. You can propose a resolution if you own at least $2,000 of the share of the company. It is a very strict rules by the Security and Exchange Commission. It is an old rule, and we call that the shareholder proposal rule. And this rule permits shareholders to file a proposal at the company if they own at least $2,000 of the share, or 1% of the company's share. So it is not so difficult to buy $2,000 of share, especially because your investment can have some positive financial return also. In the US, the limit is very low, $2,000. In France and in Europe, in most countries, the limit is higher. In France, it's about 5,000 euro, I guess. I don't remember actually, 5,000 or 5% of the company share. But I'm not sure about the precise amount, the precise limit, but it is much higher than in the US. So it's why it is less frequent in Europe than in the US. In any way, it depends on the specific rule of the country. And actually, I did not check for Vietnam, but you can try to check, for instance, by your own to see whether there is a shareholder proposal rule. I'm sure there is one, and but I don't know about the limit in Vietnam in particular. In general, it's about 1 and 5% of the company share. Okay, most of the resolution in the US was about political spending, very important issue in the US. Maybe you don't know about that, but in the US, it is not the case in all the countries in the world, but in the US, firms can give money to political parties. So of course, it raises some concern, because when a firm gives money to a political party, it hurts democracy. It is of course a political concern, but in the US they can do that. So we have a lot of resolution against political spending in the US. It is the first topic for shareholder resolution. A second topic is about executive compensation. Of course, the CEO cannot freely fix the amount of its own pay. Okay, you understand why? Because if I am a CEO and I can just consider that I need to be paid very, very, very well. So, of course, we need some control, and the shareholder controls the pay of the CEO. Remember Friedman, the CEO is an employee. So the shareholder have to fix the remuneration of the CEO. And a lot of proposals in the US are about executive compensation. We have also a lot of resolution about the composition of the board and about corporate governance in general. Okay, so most of the resolution are about compensation, board, which are issues related to corporate governance. But we have also some proposal about sustainability reporting and some specific topic like hydraulic fracturing. Hydraulic fracturing is a new technique to exploit and to produce oil, but this technique is very pollutant. So we have a lot of debate about that, especially in the US. We have also some proposal about discrimination, gender equality, or sexual orientation in the film. So those are the main topic for the shareholder resolution. I give you here. I'm sorry. You can find some statistics on internet, I give you the references about the number of proposals for the US companies in 2008 and 2020. Okay, you have the number of proposals by different topics. Okay, the same figure, but for an older period, so you can compare. We have more and more proposal, not a lot, but it's growing. More and more proposal about climate changes. Okay, and the type of investor who consider proposal, who send some proposal, mostly proposal came from the public, but also from fund managers in green and employees, okay, who are shareholders at the same time. Okay, so some figures also about the type of investors filing proposals. Okay, so it was a little bit descriptive for the moment about shareholder activism, but we have, of course, some academic articles also, and I want to discuss a paper by some French colleagues about shareholder activism, Marie Brière, Sébastien Pouget, and Loredana Uresh-Rankoum, who are colleagues in France. They have considered the engagement of two very emblematic investors, BlackRock and the Norway Fund. The idea of their paper is assess whether institutional investors, not the public, but institutional investors, do they engage with company on corporate externalities? And to examine this issue, they studied voting at shareholders' meeting, so by BlackRock and the Norway Fund. Their data is about 2014, and it's only 1 year, but because BlackRock and the Norway Fund are very large investors, the data include more than 35,000 resolutions. So it's a very large data set about shareholder resolution. And they show in their paper, you have the reference if you want some detail, or if you want, for instance, to do your paper, your final assignment on that topic. It's why I give you some references. So, their result is the following. We have a positive engagement of BlackRock and the Norway Fund, and in particular the Norway Fund. The Norway Fund is a sovereign wealth fund and is considered as the most responsible investors in the world, actually, because the Norway Fund has a strong commitment to be responsible. The Norway Fund is quite active on shareholders' resolution concerning externalities. I will not consider resolution about the traditional strategy of the firm. What is important is the resolution about environmental or social issues. So they are quite active about that. It is also the case, but in a much lower extent for BlackRock. I'm not sure you can see the figure. It's too small, but you have the references for more detail about the number of resolutions, the percentage of agreement, and so on and so on. Yeah, but I just mostly want you to remember that it is a good way to help the company to change its policy. Okay. Okay. I have discussed the case of the Norway Fund. I repeat, it is a sovereign wealth fund. I assume that you know what is a sovereign wealth fund. If you have any question, do not hesitate. Sovereign wealth funds are very popular in Asia, in China, of course, in Singapore also. We have a very large sovereign wealth fund. But it is not the topic of this course. But I hope you have seen that in other course. Now I need to discuss a little bit about BlackRock. Maybe you know a little about BlackRock. BlackRock is a huge investor. BlackRock is a major, the main asset manager in the world, and we consider usually, I do not have a prices percentage to give, but usually we consider that BlackRock own about 10% of all the companies in the world. It's massive, it's huge. BlackRock is a very large asset manager with hundreds of billions of assets to manage. Such institutional investors are very, very, very large. Maybe I will come back on this issue later. Okay. So to be clear, first, today, at least today, we have discussed about impact investment and then shareholder activism. The last section of this chapter is about green bonds. Last section of this chapter, and then we will make a break. So green bonds are any type of bond instrument where the proceeds or an equivalent amount will be exclusively applied to finance or refinance, in part or in full, new or existing eligible green project. This is the official definition by the International Capital Market Association. The International Capital Market Association has published guidelines about green bonds. So, very easy, green bond is a bond to finance or finance in part or in full. We don't care about the subtlety, but to finance a green project. Green bond is a bond to finance green project. Okay. So what is a green project? There is a list of green projects. This list is not comprehensive. It's not limited. So it's about renewable energy, it's about energy efficiency, it's about pollution prevention and control, it's about clean transportation, it's about climate change, of course, green building, circular economy. So there is a list of projects which are considered as eligible green project. And if you want to finance a project related to this list, you can consider that it is a green bond, and it will be easier for you to obtain financing. It will be easier because you can convince some responsible investors and you can pay them a lower return, and it is very important. In the case of green bond, you can have what we call a green premium, and the green premium is often called a greenium, green premium, a greenium. Okay, so it can be very interesting to issue such green bonds. Okay. So green bonds, or we have some specific green bonds related to climate change, and we call that climate bonds, but it's the same. You can find on internet an association which is a climate bonds initiative, and you will have some details again. And we have some figures about the green bond market. As you can see, it's $1.8 trillion, trillion, not billion, $1 trillion. It's still emerging. It's not so big for the moment, but again, it is growing a lot. If you consider the top 10 issuing countries in the world, as you can see, China is a very important issuer of green bond. In France also, it is very popular in France. Okay, in France, in Germany, not so in the US, and very little in ASEAN countries. This is some figure about the topic: transport, green building, energy. As you can see, it is very large also. Not only climate change, but of course energy, green building is related to climate change, but you have several categories. We have listed them already. Okay. And I wanted to insist on the fact that we have some issuance in Asia. So here you can find conventional bonds. Be careful. It was about conventional bonds in ASEAN country, and you can see that for Vietnam we have some conventional bond issuance. And issuance of green bond. Okay. To be clear, I repeat. Sorry, I want this to be very clear. So this is about conventional bond. In Vietnam, we have a good amount, about 50 billion, but zero in terms of green bond, as you can see. Compare with Laos or Myanmar, we have a larger traditional market in Vietnam, a larger traditional market, but at the same time, a lower green bond market, because we do not have, for the moment, green bond during this period. So it's important for Vietnam to be open to to introduce this new instrument. Okay, and you can just consider a very recent video by the Climate Bond Initiative, and it was about Vietnam and the green bond opportunities in Vietnam. I did not see this video. I cannot see it because it was in Vietnamese, so I cannot understand much of the video. Okay, that's it. That's it. I have just some slide about the responsible investment report of the Banque de France, but we will discuss that later, not today. Okay. So today, again, what we have discussed for the moment: impact investment, shareholder activism, and bonds. I propose you to make a break, and then we will start the third chapter. And the third chapter is about financial return. And the third chapter is a very large chapter, so we need more than one session to tackle the third chapter. So we will start it after the break, but we will finish the third chapter next time. Okay. So I propose you a break, 5, no more than 10 minutes. Okay. See you very, very soon. Okay. So the third chapter. The first chapter is about the financial performance. So it will be about finance more than about sustainability. I will discuss about return, about risk. As you can see, as always, this is chapter 3. We'll have some key concepts, and the key concept, the list is much narrower than previously. The key concept here are about risk-adjusted performance, diversification, portfolio choice. So the plan will be the following. We will not finish this chapter today, for sure, because we have too many things to consider. So first, we will discuss theoretically about the different concepts, and we will ask whether does it pay to be green, whether does it pay to be good, why this question is relevant, and I will give you some theoretical insights. But the most part of the chapter will be about empirical papers, because at the end, does it pay to be green? Does it pay to be good? Are empirical questions. So most of the chapter will be devoted to empirical studies, and we will see first empirical studies, yes, but we will see first event studies, and then funds portfolio studies, the measure of portfolio performance. Okay. So doing well by doing good. When we have discussed about the concept of CSR and SRI, I have mentioned already that it is like, quite often, it is like a win-win strategy. Is it possible to maximize at the same time both financial return and extra financial return? Is it possible? Of course, if you can maximize the two aspects at the same time, it will be wonderful for everybody. And the question is about a trade-off between financial return and extra financial return. Okay, so it is very important to have a clear view on this trade-off. To give a first insights about this trade-off, I show you a graph. So the period is not very recent, but you can do it again. it does not change a lot. And on this graph, I show both the ASPI Eurozone Index. ASPI Eurozone Index is one of the oldest sustainable index in France and in Europe. Okay, this is in blue, and in red I have considered a traditional index, which is in particular, in this case, the Dow Jones Eurostock. The Dow Jones Eurostock in red is a traditional index. And as you can see, the two indexes are very, very close. Not a lot of differences between the two. And if you look here, I have computed the returns. Okay? I have computed the returns, and on the x-axis, you have traditional return for the Dow Jones Index, and on the y-axis, on the vertical axis, you have sustainable return. And as you can see, the correlation between traditional and sustainable returns, the correlation, the coefficient of correlation is very, very high, almost equal to 1. So there is no trade-off. And it will be a first conclusion, but a very important one. A preliminary conclusion, but an important one. Sustainable investments and traditional investments provide almost the same performance. There is no under or over performance. So it is not about win-win, but it does not cost a lot. Okay. Why these indexes are so closely related? There is a strong correlation, as you have seen. Actually, it is not a surprise because the composition of ASPI is very close to the composition of the traditional Dow Jones Eurostoxx. More than 90% of the Dow Jones Eurostoxx is also included in the sustainable index. So you cannot have a lot of difference because the two are very, very close. The two indexes are very, very close in their composition. So the consequence is, of course, a very high correlation. Okay. It was not a very difficult, in terms of methodology, it was not a very difficult assessment. We will see later more sophisticated and more rigorous analysis of financial performance. But I wanted to start with a preliminary conclusion. As I said, there is not a lot of differences between sustainable performances and traditional performances. Okay, so the preliminary result, which is important to remember. Okay, we will see that we have a lot of academic paper which tackle this question of the financial performance. We have a lot of paper about the financial performance of sustainable fund. And to examine this literature, I simply count the number of occurrences of the concept of sustainable investment in newspaper and academic journals. So first, I want you to show the result of an article which has been published in Business Ethics, which is an academic journal. I give you the reference here. It is a paper that I have published 10 years ago, but you can find the paper on the with your I don't know the name of your infrastructure for internet, but you can find with the slide, you can find the paper. So the idea is to assess the growth of academic paper about socially responsible investing. So to analyze the growth of the paper and to provide a literature review, I ran an automatic request using various internet search engines. So with some keywords, socially responsible investing or investment, ethical investing, ethical investment, with those keywords, I found a large list of papers. And I have considered newspapers article with Dow Jones Factiva. Maybe you don't know about Dow Jones Factiva, but it is a search engine which is very powerful to find articles in newspapers. And I also considered, in addition to newspaper article, I also considered academic articles with search engines again, and academic article which has been published in by Elsevier, Wiley InterScience, Springer Links, or which are available with GSTOR. I'm not sure, but maybe you have access to those platforms. For those who don't know about that, those platforms are very popular because they publish most of the economic article in economics, but in other science as well. Elsevier, Wiley, Springer are the most important publisher, academic publisher. I have also used Google Scholar. So what can we see? You have the number of articles about socially responsible investment on the web, in books, in newspapers, and in academic papers. What is important is not the number. Of course, the numbers are very large. What is important is the percentage of paper which has been published about sustainable responsible investment. As you can see, the percentage is low, below 1%. It is not a surprise because, of course, there are a lot of different topics which are interesting in finance. It is a percentage of paper in finance who consider socially responsible investment topic. So the percentage is low, but is higher for academic article than in the popular web or in newspaper. What I want to show is that there is a focus of academic on this topic with the highest percentage of paper devoted to these issues. Okay, as you can see, so first result, a specific interest by academics. The second result, of course, you know about that. I have already mentioned this trend. There is a positive trend, more and more papers in newspapers, more and more papers in academic. And I have mentioned some these figures already with updated data. So, specific interest of academic, a growing trend, second result. Third, what kind of approach in this paper? We have a lot of synonyms for responsible investments. We have a lot of synonyms, but the word have meaning. It is not the same to talk about ethical investments or social investment or responsible investment or green investment. It is not the same. And for instance, the word ethics, the term ethics, was very important at the beginning, 30, 40 years ago. The term ethic was popular in newspaper and in academic journal, but you can see the trend is decreasing. The number of papers about responsible investment, sorry, I repeat, we have less and less paper about responsible investment, which mention the term ethics. The term ethics has almost disappeared today. It is not a problem about ethics. Okay. So, what does it mean? It means that the philosophy behind socially responsible tend to vanish. It is more a business issue today than an ethical issue, which is important. Was my first remark. Okay, and we can also try to consider the different concepts, the trend, and in addition to the word ethic, I try to find a percentage of article with some important concept. For instance, altruism, sacrifice, moral, religion, performance, diversification, okay, best in class, screening, strategy, and so on, to see some trends. And I will show you the result in the table. We have, you can see the last column with the difference, the trend difference. So what is important? We have less paper about religion, about moral, about sacrifice, about altruism. There is not a lot of paper about that. The trend is negative. But, so, all these theoretical concepts are less and less used. On the contrary, all the word with a management approach, like the word performance, diversification, best-in-class strategy, are more and more used. there is a change from an ethical approach toward a more management-oriented approach. Okay. And if you consider the topic, you can see that corporate governance, climate are increasing topic. But South Africa, for instance, is a decreasing topic, of course, because the situation in Africa is less. There is no more explicit apartheid regime in South Africa, so it is not this issue is less relevant today than it was 20 years ago or 40 years ago. Okay. Okay. The previous table was about newspaper article, and this table will show you the same, but for academic article, you can see a decrease for ethical concept and an increase of the managerial concept. And also, I suggest to focus on that line. The concept of performance is very, very often used in the literature about socially responsible investing. 3 out of 4, 72% of the article are devoted to performance, which is very important. A lot of articles about performance and about financial performance. And it is quite surprising. It is quite surprising because sustainable investment is about society, environment, it's about ethics. But the most important concept in the academic literature is the concept of performance, which is not the goal of sustainable investment. A priori, the goal is not to have a strong, high performance. We have a kind of a paradox. So to sum up this last point, I wanted to say that actually we have some kind of type 3 error. Do you know about econometrics? I hope you have some econometrics background. You know about type 1 and type 2 error. The type 3 error is the following. It's completely different. The type 3 error is to produce the right answer to a wrong question. We have a lot of paper about financial performance. And as I said, it is a kind of paradox because we can consider that the question of the financial performance is not the most important one. So we have right answer to a wrong question. The wrong question in particular here is the question of the financial performance. Okay. Whatever, we will try to explain why we have so many papers about financial performance. And the answer is that because firms have an interest in this. Firms, and in particular in the financial sectors, investors, agency, institutional investors, and financial intermediaries, all these actors in the financial industry are are more concerned by performance than by social impact or environmental impact. Okay, and it is not a surprise. But researchers also have an interest in financial performance. And one explanation is that financial performance is easier, much more easy to address, to measure than non-financial performance. Okay, so it can explain why we have so many articles about financial performance. There is a comics which I found funny about this idea. For most or for some professional practitioner or even some professor, the idea of social responsibility is actually to make more profit. So it's a very important concern, the concern of greenwashing. Okay, so I hope you find this comic funny too. Okay. Does it pay to be good? As I said already, more than 3 out of 4 of academic publication on responsible investment focus on financial performance. Another way to understand this phenomenon is to learn about the lamppost syndrome. Do you know about the lamppost syndrome? It is a general tendency to overanalyze data. Okay, and as a researcher, I already said that when you are a researcher, you prefer to have, it is easier to have paper on financial performance because it is easier to measure. This is the lamppost syndrome. I try to explain. I did this slide to be clear about the lamppost syndrome. It is a funny story. Okay, it does not exist in reality. It is just a joke. Okay, it is a joke by economists. So maybe not so funny, but it is like a joke. So there is a woman, and a woman sees a man looking for his keys under a lamppost outside a tunnel. So she is a nice woman, so she proposed to help him, and she asked where he left his keys. And actually, the man said that he lost the keys inside the tunnel. So the woman looks puzzled, and she said, but why are you looking for your keys under the lamppost while you have lost your keys inside the tunnel, not outside? It is quite strange. So that's why the woman was puzzled. And the man said, and it is a funny part of the joke, and the man said, because I see much better here. I see much better under the lamppost than outside, than inside the tunnel. Okay, so he tried to find something, but at the wrong place, and it is sometimes a problem with economists. We are looking very rigorously. We are concerned very rigorously with some issues, but maybe not the most relevant issues. And it is a problem in the literature about sustainable finance. We look at the financial performance, while the financial performance is not the main issue, or should not be the main issue. Okay, so we have, I will try, I will try to summarize this issue, don't worry. So we have more than 50 academic papers on sustainable, on socially responsible fund performance. More than 50 academic papers. And all these papers, almost all these papers, which are, for most of them, very rigorous, find no significant results. I will describe them later, but I can give you the conclusion right now. Academic studies find no significant results. Socially responsible funds do not overperform, but they do not underperform. The performance is the same than for traditional funds. Okay, this result is not new. I mentioned it with index, socially responsible index. I said that there is no differences. There are no differences, and it is the same for responsible fund. We have few papers that show a positive or negative performance, but very few papers. And for almost all academic studies, no significant results. Okay. It is interesting also to think about the theoretical arguments to understand the impact of responsible investment, the impact on performance. And you can maybe just think about that by yourself, or in any way I will give you some answers, but in which cases could we expect a positive impact of responsible fund? In which cases does it pay to be green, or does it pay to be good? Why? Actually, we have for now 30 years some paper which have tackled this issue, and they provided some good arguments. So here I have tried to list those arguments. So first, there are some cost benefits. There are some cost benefits associated to CSR. Better prevention. Because you apply a CSR approach, it is likely, not sure, but likely you can reduce some risk because you have this CSR approach, because you have this sustainable approach. And because you reduce risk, you reduce damage, you reduce accidents. And because you reduce damage and accident, you reduce insurance costs. Okay, so you have a cost benefit to consider social and environmental risk. In addition, CSR can help you to anticipate future regulatory constraints. For instance, today you do not have, you have to pay in many countries, but the price is quite low. You have to pay for your carbon emission, but the price is low. But we can imagine that the price will go up with climate change. So if you have a sustainable approach, you can anticipate future regulation, which will impact your cost, for instance, the price of the carbon. So it is better to anticipate sometime, and it can be a cost benefit. You can also reduce cost related to strikes by your employee, because you take into account societal concern. So, for instance, gender diversity. So, if you are a good company, you can reduce the likelihood of strikes. You can also reduce costs related to boycott by consumers. So there are some cost benefits associated to a better prevention and sustainable approach. Okay, this is the first category. You can reduce also cost, because if you have a sustainable approach, you can save on material and you can save on energy. So this is, of course, a good point for your company. And because of your sustainable approach, you can lower your cost of capital, as you have seen at the beginning of this session today. Investors are willing to accept a lower return, so it will lower your cost of capital if you have a sustainable approach. Okay. So all these arguments claim that you can lower your costs. Okay. Oh, I'm sorry, there is some word in French I did not notice. Okay, it was not in English. I have mixed, sorry. And you have also some revenue benefits, cost benefits, but also revenue benefits. This is another kind of argument. When you have a sustainable approach, you can generate brand equity. If you are considered as a responsible firm, you can attract more customers, you can attract more investors. So it can increase your revenue. It is, of course, a strong argument. And there is also a positive impact. If you have good labor relationship, it will improve employee productivity. When employees are satisfied by their company, their productivity is higher. So it's good to work in a sustainable company. Okay. So we have a list of different arguments in favor of sustainability. That sustainability can be profitable for all those reasons. Okay. In theory at least. In practice, you have also some cost. It costs to have a sustainable approach, and sometimes the cost can be higher than the benefit. So you have you have a trade-off. It is not always a win-win approach. You have sometimes to pay to save energy. You have to pay to have a more environmentally friendly approach. Sometimes it costs a lot. So there is a trade-off between benefits and cost. And the result at the end is an empirical question. Okay, we will see the empirical paper later. Okay. The theoretical relationship between financial performance and social performance can be positive or negative. Okay. As I said, there is a trade-off. Sometimes the advantages are higher than the drawbacks. Sometimes it is not the case. So the relationship between social performance, the acronym here is for corporate social performance, social or environmental actually. And the acronym here is for corporate financial performance. And the idea is that it can be positive or negative in theory. And we need also to understand the causality. Maybe it is because you have a corporate social performance which is good, and it implies better financial performance. Maybe the causality is like this, but we can have also another causality. And if you see correlation between financial performance and social performance, this correlation can be due to the fact that financial performance owes social and environmental performance. It's very important. It is not the same to have the causality here or to have this kind of causality. And last possible case, it's when the causality is bidirectional. We can have a bidirectional relationship between corporate social performance and corporate financial performance. So, a positive or negative relationship and different kind of causality. So, we will have 6 different possible cases in theory. I will describe the first one. If you have a positive relationship between corporate social and environmental performance to corporate financial performance, it is what we have discussed already. It is a win-win strategy. Sometimes we call it the double dividend. You have an environmental or social dividend plus a financial dividend. Okay, we have both. In this case, we have both. It is the win-win strategy. If the relationship is negative, it is because there is a trade-off. There is a trade-off between environment and financial performance. Okay, for these two kind of results. If the causality runs from finance to social and environmental performance, and we have in theory this case which is possible. Imagine a firm with very high profits. It is easy for this firm to pay for environment, to pay for better welfare of the employees. So this is a slack theory. The correlation between financial performance and environmental or social performance, the correlation could be due to the fact that the company with high profit can afford and pay for to be good. It is much more, to sum up and to caricaturize, it is much more easy to be generous when you are rich. If you are rich, it is very easy to be generous. Right? And of course, it applies to firms also. It is what we call the slack theory, a correlation between financial and social performance, but a correlation due to a causality from finance to environment and social issues. Okay, this is the third case. The fourth case now, managerial opportunism. You have a negative relationship because the idea is that when you have high corporate financial performance, you will decrease corporate social responsibility. Okay, it is like some kind of managerial opportunism. And then it is in practice very likely the causality can be directional, can run in both sense. We have at the same time an impact of finance and environment and the impact of your environmental concern on your financial performance. So you can have a positive or a negative synergy. So it means that it can run in both directions for the causality. So it is important to have a clear view of the different kind of relationship. It is important, and in practice, it is very difficult to disentangle this impact. You know that in econometrics, you can have some correlation, but it is not enough to find a correlation. You should be able to find causality in addition to correlation. Sometimes it's not possible, but if you can do, it's better to have clear causality than correlation. Okay. Before the discussion, the empirical discussion, you need also to learn about the different sources of information to measure social and environmental performance. We will have a chapter, the following chapter will be devoted to this issue, but I need to present some source. Okay, so the most the easiest source are newspapers, like Wall Street Journal and the Financial Times or whatever. In newspaper, you can find articles about environmental and social performance of the firm. We have very often within such newspaper article about pollution or social performance. And the availability is fine. It is when you have a plus, it is because it is positive criteria. The problem is that it is not parsimonious. Okay, if you want some data, you want, for instance, it is better to have an Excel file with all the firm and for each firm, financial and social and environmental performance. It will be great to have this. In newspaper, of course, you do not have such parsimonious approach. You just have article, qualitative article, so you have to find some information in each article. So availability, it's great. The time delay also is great because articles are published usually one day after a specific event. And with internet, sometimes it's lower, so you can have access to very recent information, but it is very difficult to tackle all those information. So this is a problem. So we have a minus sign, a negative sign here. Another source of information is official publication. Easy to find, very easy to find, often free. So it is a good point. So we have a plus. It is in terms of parsimony, it is quite good because official publication most often attempt to provide a large view. So it is parsimonious. The reliability, I didn't consider the reliability before, but it is also important to have a rigorous source of information, and it is the case with official publication. The problem is that the time delay can be very long, and the richness can be not so good also. Because in such official publication, you will have some specific issue and not a global view. So it can be a problem. Of course, you can ask to the firm themselves, and you can collect all the firm press release. Firms press releases are very frequent, so you have a rich source of information, but the main concern is reliability. It is very easy to access. Maybe I could indicate a plus here because it is now easy to access via annual report and via information providers like Bloomberg or Reuters or CompuStat or so on. Okay. But the main problem is the reliability. When the firm publish some information, you cannot be sure of the rigorousness of this information. Fourth source of information are NGOs, associations like Amnesty International, Friends of Earth, Human Rights Watch, Transparency International, Oxfam, and so on. We have a lot of associations and this association do a great work. They are like alerts, and they are very, very useful. And most of the time, information is very easily available and very rich, but it is not parsimonious and it is not very reliable sometimes. Sorry, just 1 minute. Okay, and the last source of information is about CSR rating agency. In this case, it is very uniform, and there is a methodology which is not very transparent, but we have some very uniform data, and it is the easiest database for research. The problem is a time delay because we can have an assessment of corporate social risk about CSR rating, but it is not updated very quickly. Okay, so this is for the source of information. If you want to do some research about CSR, it is important. I have a question just before. In the previous slide, sorry, just. Okay, so I'm sorry. So CSP is an acronym. I mentioned it, but I read it is about corporate social. Sorry, I'm trying to write at the same time. Corporate, social, and environmental. Okay. And CFP is for corporate financial performance. Okay. Oh, you're welcome. It's important to understand the acronym. Okay. So then I have proposed a different source of information. Okay. There's also a remark. You have to be very clear on that point. You have to be aware that economic performance and financial performance are two separate things. Okay? There is very often some confusion between economic and financial performance. You have to separate the two. For investors, and I'm doing finance, so I take the point of view of an investor. For investor, the question of economic performance is not very relevant. The question, I repeat, because it is something sometimes not very clear, but economic performance, I don't care. It is not important for an investor. Okay. Why? Because I will take an example. Okay. Let's assume that the eco-efficiency hypothesis is verified. The eco-efficiency hypothesis is a win-win strategy. Okay. In this case, investors, whether they are guided by economic motive or not, will all want to buy the securities issued by these good companies. So the price of the securities will rise. And if the price rises, there will be lower return. And because of that, you will have poor performance for investors. Okay. So be careful of that. If you have good economic performance, a lot of shareholders will want to buy the share. And because they want to buy the share, the price goes up. And because the price goes up, the lower you will have lower return and poor financial performance. So it is very basic in economics and finance, but you have to be aware of the difference between economic and financial performance. And when you consider the point of view of investors, it is important to consider the financial performance instead of the economic performance. So the idea is to measure economic performance. Oh, sorry. Sorry. The idea is to measure economic performance and financial performance with different indicators. To measure economic performance, you can use return on assets. You can use return on equity. You can use several accounting ratios, which are quite popular. You can use Tobin's Q, for instance. And if you have a seminar in corporate finance, I'm sure you know about this kind of ratio. But if you want to measure financial performance, you have to measure financial return. Okay. It's not accounting ratio, it's market-based information. You need to have the price of the stocks and you have to compute returns. And of course, returns are not enough. You need also to compute the volatility. So the volatility, as you know, is based on the variance of the return. So it is different approach. And in the following, we will insist on the financial view. We will insist on investors. Okay, and how investors measure performance, and in particular the performance of sustainable investment funds. Okay. So, as I said, most of the chapter will be about empirical studies. Okay. We'll have several empirical studies which try to assess the financial performance for investors. Okay. We have two kinds of studies. We have event studies, which measure the performance at one moment in the time, consecutive to a specific event, and in our case, an event related to the environment mostly. So we have like a photography at one moment in time. It's about event studies. And we have also empirical studies based on the time series. It's not a photography, but it's like a video, and we will use some time series to assess the return and the risk measured by the volatility of the fund's portfolio. So we will see the different approach. First, event studies and fund portfolio. Okay. We will see that in the next session. I will propose you, because we have 5 minutes left, I guess, I propose you to stop now, because it is not very useful to start a new, very important section in 5 minutes. It is not possible. So remember that, and I propose you to read the paper if you can, or just have a look at this paper that I will present in the next session. Okay? Is it okay for you? We did only one break today because I started with some delay, so to be on time, I just consider one break. Okay, but we are on time, don't worry, and we will see the empirical part next time. Is it okay for you? Okay, again, do not hesitate if you have any question, and try to find an academic paper soon. You have the weekend to find it. Try to compose your group, try to find an article, and send me email. Okay, send me email when you have found a good article.